Welcome and thank you for being here today. Through the B.U.I.L.D.S project, we have partnered with 4 stakeholder partners who will be conducting a 4-part webinar series. This video serves as a self-paced learning tool providing B.U.I.L.D.S organizations with educational content in an easy-to-find and consumable format on topics related to strengthening their organizational and service capacity in the settlement sector. Diversity recognizes that our work takes place on the ancestral, traditional, and unceded territories of the Semiahmoo, the Katzie, Kwakwutlam, Kwantlen, Kaikiat, Musqueam, and Tawasin First Nations. The knowledge, traditions, and ongoing contributions of these communities are significant in providing context to the work we do, and diversity recognizes the importance that reconciliation has in building truly inclusive and strong communities. The B.U.I.L.D.S project is funded by Immigration, Refugees, and Citizenship Canada, and we are grateful to IRCC for supporting this important work in the settlement sector. We are honored to have Pamela Oliva from Humanity Financial lead today's session. She will offer essential readings and tools to help you get started on key topics such as budgeting, financial reporting, internal controls, and board governance. These resources will provide a solid foundation for managing your non-for-profit's finances effectively and confidently. Following the presentation, Humanity Financial has provided resources for further reading that will be included in a resource guide. Once again, I want to thank you for coming, and without further ado, the presentation will begin.
Hello and welcome to the webinar for today on financial management. Before I begin, I would like to begin with our land honouring statement. Our office is located on the unceded, never surrendered, stolen, traditional and ancestral territories of the Musqueam, Squamish and Tsleil-Waututh nations, who have been stewards of these lands since time immemorial. As an uninvited settler on this land, I recognise the responsibility I have to actively participate in decolonising practices that address Canada's colonial past and the ongoing subjugation of Indigenous people. We are privileged to work, live and play here. I would also like to acknowledge that I'm personally joining you from the traditional territories of the Blackfoot Nations, which includes the Siksika, the Piikani and the Kainai. I also acknowledge the Tsuut'ina, Stoney Nakoda First Nations, the Métis Nation, and all people who make their home in the Treaty 7 region of the lands commonly known as Southern Alberta. My name is Pamela, and I'm the VP of Client Services for Humanity Financial Management. We're not your typical accounting firm, nor are we your typical accountants. We work exclusively with the social purpose sector and First Nations from coast to coast to coast. Our vision for the future is that one day soon, every organisation and community will experience the freedom of financial liberation. Our mission is to unleash the power of purpose-driven organisations, to release their vision of change by counting beyond the numbers and measuring true value creation. The presentation today is for information purposes only and current only as at today's date. It should also not be considered formal tax or legal advice. We've also provided an information sheet to support this presentation with detailed links to Canada Revenue Agency, which will always have the most up-to-date and in-depth information should you seek to explore any of the topics that we're going to be talking about today in greater detail. At Humanity Financial, all we do is underpinned by our theory of change, called the 5 stages of financial wellness for social purpose organisations. We believe in the importance of bringing attention to the critical role the finance function and financial information can play in achieving an organisation's mission. Financial information, when timely and correct, opens an exciting door to making informed operational and strategic decisions that mitigate risk and take advantage of opportunities. It can be transformational. So let's consider these questions for a moment. How is your organization's well-being? Is your organization financially healthy? Is your organization financially sustainable? What about your annual financial performance compared to your peers? Many organizations struggle to answer these questions. If their budgeted revenue for the current year is enough to cover expenses and they're getting timely and accurate financial reporting, all is pretty good from a financial perspective, right? We think organizations who view finances solely from this point of view may be missing out on a huge opportunity to use finances strategically to improve annual financial performance and increase the financial health and sustainability of their organizations. It's all about setting and achieving financial goals in addition to the program and organizational goals that we might have in our strategic plan. Organizational financial planning has much in common with strategic planning and strategic frameworks. We start by identifying where we are today and agreeing on where we want to be in 3, 5, or 25 years. We then implement strategies and a plan to make this happen. To understand financial well-being, it can be useful to start with some basic financial questions. For an organization, what does a good annual financial performance look like, aside from meeting the budget? What does it mean to be financially healthy or financially sustainable? Through our work with many social purpose organizations, we've come to classify organizations in one of 5 stages of financial well-being, divided into 2 overall sections: financial compliance, financial liberation. So I'm going to take you through what those 5 stages are right now. So the first here is with a compliance focus, and we'll start with financial crisis. And what I'm going to do is to describe in stage 1 financial crisis what we tend to see isn't in place, and therefore what we'll always start at Humanity Financial with addressing as a first, it's the highest priority. So in stage 1 financial crisis, we have observed at Humanity Financial that bookkeeping cycles are usually not in place. Things like accounts payable and accounts receivable and payroll may not be getting processed in a timely manner. Management may not be receiving accurate financial reports or even timely financial reports. Sometimes the reporting may be months behind. Compliance may be behind. There may be no budget in place. This is a really uneasy place to be. And so we seek to always address these items first. And once ticking all these items, we say that an organisation is out of financial crisis and into stage 2, financial fragility. I always think that stage 2, financial fragility, is a very critical stage in the 5 stages of financial wellness, because it's often, from my perspective, a blind spot for many organisations. Having gone through all of the work of catching things up and getting some basic bookkeeping cycles in place, financial fragility really represents getting that strong foundation, bit of a tree trunk, to protect all the work that you've done to get out of stage 1 financial crisis. So to navigate out of financial fragility, we will focus on 3 kind of key areas, and that is ensuring that there's policies and procedures in place, that there's effective and efficient financial systems, and that you've got the right team in your finance, for your finance team, the right roles, for the right functions, the right size of the team to meet the needs of your organisations. So once addressing all of those things, we say that an organisation has reached stage 3, financial stability. So once all of those things are done, they'll have a robust financial system, they'll be timely, there'll be accurate financial reporting, You'll have documented and efficient and effective financial procedures. And in my and at Humanity's view, at this point, a really exciting door opens, and with it, the opportunity to start using financial information as a tool for looking forward. That strategic lens, as opposed to one of simply compliance or looking behind, and by its very nature, it's very backwards looking. I can't emphasize enough, however, the importance of the historical, because without the confidence in your financial information or the integrity of your data, it's very hard to rely on that information to start making plans or testing assumptions about the future. They really go hand in hand. So what do we need to do to navigate out of stage 3 and into stage 4, financial strength? Well, at this point, we will focus on financial modelling or setting KPIs, really focusing on measuring things that matter. There's also a focus here too on financial literacy throughout the organisation. So in earlier stages, finances might be just the sole function of the finance team. It doesn't tend to go outside of the finance team. But at this stage, we really focus on making sure that there's financial literacy kind of throughout the organisation. If you've got program managers, board all the way through, the more eyes that are on your financial information and engaged in reviewing the financial information and having conversations about your financial information, that's only going to strengthen your organisation. At this point, we'll also design financial information that's tailored to different user groups within an organisation. For example, your board will have different user needs than your program managers. Okay. So stage 4, financial strength. This is an exciting place to be. In stage 4, we'll be focusing on activities like looking at multi-year financial forecasts. So again, with the confidence in the historical data, focusing on those items in stage 2, financial fragility, to make sure you've got a strong foundation. It really is a wonderful opportunity now to look forward and be able to make multi-year financial forecasts. At this point, we will also start looking at some revenue diversification strategies. Many not-for-profits have revenue that comes from one or two main sources. And so we will offer various strategies that a not-for-profit may want to consider to diversify that, to make sure that all eggs aren't in that one bucket. We'll also focus on activities like developing fund and fund development strategies. And this will be really different for each not-for-profit, depending on their vision and their mission and the type of fundraising activities that they're wanting or willing to engage in. And at this point in time, there will also be activities such as impact measurement assessment. So again, this is really asking some important questions about tying some important data to vision and mission and impact. Stage 5 is financial liberation. In stage 5, there will be a focus on implementing and the ongoing refining of the strategies and modelling identified in stage 4. There will have been the realisation of own source revenue. So really diversifying where the revenue is coming from, which is going to strengthen a not-for-profit organisation, not put it at risk if one source of funding is lost due to, for example, a change in government. Here there will be financial health and sustainability, and organisations will be in a position to be really actively working on strategic solutions for mission achievement and advocating and collaborating with others in your network. So many organisations get stuck at stage 3, financial stability, and may not move on to treat finances strategically. And so as a result, they don't spend time planning their finances or setting and achieving strategic or specific goals for financial health, financial performance, or financial sustainability. And that's fine if you're content with status quo, but if you aspire to financial abundance and financial liberation, it takes an investment of time and resources to undertake financial planning and then to monitor and evaluate progress towards your goals. So organizational financial health and performance can be measured in lots of different ways. And it really is involved or centers on asking the right questions at the right time. So I'm going to take you through some of the questions you may want to consider as you consider the second tier, using financial information with that real strategic focus. Now, some of the questions that you may want to ask are, how many months of expenses does the organization have in cash and liquid unrestricted net assets? How dependent is the organization on short-term restricted donor funding? What percentage of the organization's funding is long-term, own source, or unrestricted funding? Is most funding received in advance of spending or following spending? Is the organization able to pay market rate compensation benefits, pensions comparable to other not-for-profits? This is a very often real challenge in retaining, great people. Does the organization expect significant overtime from its employees? And this is, a common occurrence in not-for-profit organizations. What percentage of revenue is spent on salaries compared to other organizations? That's at benchmarking. And what percentage of revenue is from government or foundation sources? And when we start thinking about financial sustainability, that's stage 5. We really start asking some more complex questions. And these questions are things like, given the impact we want to have, do we have the right business model and funding model? What core fundraising capacities should we develop? Do we have the best funding mix for our organisation with respect to short-term versus long-term funding? And with respect to restricted and unrestricted funds? Do we have the best funding mix for our organisation? Are we attracting funding from the best sources given our cause? Are there other sources of funding that we should be considering? Are we using the right strategies to attract those funding sources? So every social purpose organisation is unique and needs to answer these questions for their organisation. The right answers at any given time will really depend on the nature of the organisation's work, which stage of financial wellbeing they're currently in, and in what stage they're at in their non-profit life cycle. So we understand that many of you may be considering whether to incorporate or not to incorporate. So the next few slides are going to consider or discuss with you some of the considerations or some of the information that you may want to consider when making this really important decision. So we're going to be talking about the benefits of incorporation, doors that are opened if you incorporate, legal liability, bank accounts, how to incorporate, the ins and outs. So what are some benefits of incorporation? Well, some of those benefits are that there's a separate legal entity. An incorporated entity has the same rights as a real person. It's its own separate existence. It can enter into contracts, it can sue and be sued in its own name, and it can own property and get loans. Another benefit of incorporation is limited liability. What does that mean? So members and directors and officers are protected against being held personally liable for the non-profit entity's debts and liabilities. We're going to talk about this one a little bit further later. It shouldn't give the impression that there is complete protection here. we'll talk about some of the exposures with the CRA. Another benefit is perpetual existence. An incorporated nonprofit has the statutory right to exist in perpetuity. So one of the critical considerations that influences the decision to incorporate or not is the ability to access funding. So many government and non-government funding bodies will not consider applications for funding from unincorporated entities because and therefore that really greatly limits the abilities of groups to further their mission. So now let's consider doors that are opened. And they are increased revenue to achieve core mission. But depending on the nature of your mission, it's highly likely that you'll need cash and revenue, unless, of course, you and all involved are committing to serving the purpose on a volunteer basis. But many groups, grassroots groups, will require revenue to broaden their reach. Whilst competing for funding applications and searching for the opportunity amongst the plethora of opportunities requires a lot of time, accessing funding remains the most widely used mechanism to really turbocharge the ability for groups to organise. It is really super important to remember, though, that once you begin receiving any funding you hold, the reporting obligations that come with it may be quite significant. So funding agreements are very prescriptive and have numerous reporting obligations embedded within the terms of agreements. And not complying means that you carry the risk of needing or potentially having to repay the funds. With incorporation comes the benefit of more people to help you achieve your core mission. Always a big positive. Where possible, you should try and consider what key expertise and background is needed on your board to build a solid governance structure. For example, you should try and have financial expertise, governance expertise, fundraising, legal expertise. And so as a flow-on effect from all of this, your organisation is able to expand its reach and have the opportunity for more partnerships and allies. So what is the legal liability when it comes to incorporating? So directors themselves, although there is limited liability, it doesn't mean no liability. So directors of an incorporated not-for-profit can be held personally liable if the entity doesn't properly deduct or pay EI, income tax, or CPP. We also spoke earlier about the responsibilities that come with funding agreements. There are also responsibilities once employees are engaged to the CRA. And in addition, the directors themselves must be aware of their collective legal duties of care. And we'll be going through that in more detail shortly. So in order to protect organisations, it's really important once you incorporate that one of the first things that you do is to obtain adequate insurance to cover your particular situation. And insurance, like directors and officers insurance, is absolutely critical. So when you're incorporating, you'll have to consider who will be authorised as a signatory. And signatories will approve online payments, sign cheques, as well as commit the organisation legally to things like a funding agreement. We always recommend at least 2 signatories to be set up, and that payments and cheques require 2 actual signatures before they can be released. So with increased reliance on funding and funding agreements, always pay special attention to any terms and conditions regarding where the actual funds can be held. Some funders require that the funding be held in their own specific and sometimes separate bank account and not mixed with other funding. And so that means that A small not-for-profit may end up having multiple bank accounts. Other funding may not ask or have that stipulation. Additionally, some funding agreements may have stipulations about how interest is accrued on the funding that's received, how it can be spent, and how interest may need to be reported. If in doubt, it's always wise to double check with the funder. Okay, so you've considered all of the items previously and you've decided to go for it. You're going to incorporate. And so how do you actually go about doing that? So you can go down the avenue of being provincially or federally incorporated. And there's going to be the legal side and the CRA side that you'll have to navigate. So let's start with the legal considerations first, and then we'll talk about the CRA considerations, and then we're going to go through a step-by-step process. So it's important to know that when it comes to incorporating provincially, that the framework, the regulatory framework, is going to vary quite significantly province by province. So they'll have different requirements, particularly when it comes to things like the audit requirements or payments to directors. So it's really important to pay close attention to the framework in the province that you're incorporating. If you decide to incorporate under the federal regulatory framework, there's again some differences that you have to be mindful of. There's some additional extra reporting requirements, such as the need to lodge an annual return within 60 days of a corporation's anniversary date. So what do you need to do or consider when it comes to the CRA? So once you have incorporated and gone through the legal process, the second step is to consider what you're going to do on the organisation's first annual T2. So if you've incorporated as a not-for-profit, it will be important for you to elect to be treated as a non-profit organisation on your annual T2 form. That essentially acts as the mechanism to let the CRA know of your status as a not-for-profit organisation, as opposed to going through a kind of like a formal registration process. So if you contrast this with the requirements that the CRA expects not-for-profits to go through when it comes to registering as a charity, that process is quite long. It can take 6 to 9 months, even longer. And the requirements and the considerations to even be granted recognition as a charity are significant, and we'll go through that in just a moment. So how do these two steps overlap? Okay, well, when you incorporate either provincially or federally, you'll have to compile your first bylaws. The bylaws, as distinct from policies, must be adhered to, and the bylaws contain things like who can be a member, your purpose, who can be a director, the terms of a director, the officers, meetings and quorums, amongst many other things. You'll also need to include the names of your directors on the forms for legal incorporation. If your society plans to register as a charity under the Income Tax Act, you need to make sure the society's objectives or purposes meet Canada Revenue Agency requirements. So that's really important to keep in mind. If you have any desire to register as a charity as opposed to a non-profit, you'll have to be very intentional about how your bylaws are set up. So let's summarise the key steps. Firstly, determine who your directors will be, develop your bylaws, and consider down the track if you want to be approved as a charity, as they'll be looking at very specific things in your bylaws. So you want to take the opportunity just to answer that question right at the very beginning before you incorporate. You'll complete the application and you'll lodge and pay the fee. From there, you'll always want to ensure from day one that you adhere by the requirements set out in your bylaws. After that, after incorporation on the first T2, elect to be treated as a non-profit organisation on the annual T2, and that lets the CRA know of your non-profit status. And from there, the final step is to decide if you want to go down the road of registering as a charity. And this may take many months, and very often organisations will obtain some additional legal assistance to ensure that the application process itself satisfies all the requirements of the Canada Revenue Agency. Okay, so you've decided to incorporate. Now what? So with incorporation comes lots of additional obligations. We've already spoken about the benefits of incorporating, but now there's additional considerations. You've got an organisation now. There are extra considerations that need to take place. So in the next set of slides, we're going to be talking about the difference between non-profit organisations and charities, because it really matters which one you are in terms of the obligations that you need to make sure you're staying on top of, your board and its responsibilities, some key foundational financial policies that you will want to have in place after you incorporate. We're going to spend some time talking about financial statements, the key things to know, and finally we're going to finish up with why all of this matters, and I promise you it really, really does. Okay. So what is the difference between a non-profit and charity? So we spent some time talking about incorporating, benefits of incorporating, and the steps to go through when incorporating, and highlighting that if you want to be registered as a charity, it's quite a long process and you have to pay a little bit of extra attention on the wording in your bylaws. So let's go through exactly what the CRA considers as the differences between a non-profit and a charity, because they're very specific. We already know that's a very long process to be registered as a charity. So according to the CRA, this is all according to the CRA, there's additional information on the CRA website. A non-profit is a club, society or association that is not a registered charity and that is organised and operated exclusively for social welfare, civic improvement, pleasure, recreation, or any other purpose except for. So no part of the income of a not-for-profit organisation can be payable to or available for the personal benefit of any proprietor, member, or shareholder, unless the MPO is a CAAA. That's the definition according to the CRA. When it comes to registration, under non-profit, there's no registration process for income tax purposes, and a charity must apply to the CRA and be approved for registration as a charity. So we mentioned earlier, if you're a not-for-profit and you want to stay as a not-for-profit, you simply have to tick that box on your T2 and your return that lets the CRA know that you're a not-for-profit. Whereas if you want to be recognised as a charity by the CRA, you have to go through a formal application process. The CRA really pays attention to the purposes of the not-for-profit, and they'll really look at the bylaws here. So according to the CRA, the purpose of a non-profit is social welfare, civic improvement, pleasure, recreation, or any other purpose except profit. Whereas for a charity, so this is the key distinction here, a charity must be involved in the relief of poverty, education, religion, or other charitable purpose. So you'll have to satisfy that purpose, that you're set up for those purposes in your bylaws. When it comes to tax receipts, a non-profit cannot issue official donation receipts for income tax purposes, so that's a no. Whereas charity, if you receive that, if you become registered as a charity, you can issue official donation receipts for income tax purposes. That's a very big difference. Non-profit, you can't. If you're registered as a charity, you can issue those donation receipts. It's a very important consideration depending on what you decide your sources of revenue are going to come from. When it comes to funding, a non-profit can't receive funding from foundations and charities, although this is changing due to what's called non-qualified donees. And I encourage you to, again, seek further information on the Canada Revenue Agency website regarding this. And charities may receive funding from foundations and other charities. So again, another key distinction there. When it comes to tax exempt status, so a non-profit is generally exempt from paying income tax, and charities are absolutely exempt from paying income tax. In terms of the legal structure, a non-profit is usually a corporation or a society, and a charity is a non-for-profit corporation or society. When it comes to personal benefit, both non-profit and a charity have to make sure that there's no personal benefit for members or anybody else. And for the beneficiaries and non-profit beneficiaries has to be the public, community, or members. And for a charity, it has to be a wider public or a significant section of the public. So again, the CRA will look at the activities of a not-for-profit and look at whether the beneficiaries are to the public or a significant section of it in order to deem it eligible for charity status. So once you're incorporated, you'll have a board, and directors will need to ensure that it acts and with a fiduciary duty of care to act honestly, in good faith, and in the best interests of the organisation. So directors need to ask themselves, how would a reasonably prudent person conduct the affairs of the organisation? So they've got a duty of care. So directors have a duty of competence, i.e. a requirement to act with a certain level of skill. And this duty of care really describes the level of attention required of a director and can be described as a duty to be informed and to act with competence and diligence. A director must generally be informed about an issue before making a business decision relating to it. The law doesn't require directors to be experts, but rather to act in accordance with a particular standard of care. The standard of care expected of directors is explained furthermore. There's also a duty of loyalty. The duty of loyalty requires that a director acts honestly and in good faith in the best interests of the organisation. The duty of loyalty is a personal duty and can't be delegated. This means, amongst other things, that a director generally is not allowed to profit from his or her position and must avoid all situations with the duty that they have to the organisation and make sure that it doesn't act in conflict with responsibilities that they may have for other organisations or activities. once you're incorporated, it's going to be really important to set up some key foundational policies. So if you recall, in the 5 stages of financial wellness, we spoke about stage 2, financial fragility. And that's that real tree trunk foundational, but sometimes a bit of a blind spot for many organisations. All of these things really protect employees, the board. It's a strong framework. So no matter who comes and goes in your not-for-profit, having these key policies ensures that decisions continue to be made in a consistent and transparent way. So here are some key policies that we at Humanity Financial recommend as foundational policies. So one of the most important ones is what's called a delegation of authority policy. And the delegation of authority policy outlines who has responsibility to firstly commit the organisation to spend, as distinct from who has the authority to release a payment, for example, signing on a cheque. They can be 2 quite different things. So if somebody within your organisation has authority, for example, to put in an order for some stationery, for example, you may want to give employees authority to commit the organisation to, for example, up to $1,000 as an example. And then when it comes to releasing that payment, that $1,000 for that stationery, that may be, doesn't always, but it may be 2 different people who actually then release the payment from the bank. It's very often that as an organisation grows, that there'll be different limits. And so you may have program managers who have a limit of authority up to a few $1,000s perhaps. And then anything above that has to go to a CEO. And then again, another threshold may be that anything above a certain dollar value, say 15,000, may need to go to the full board for approval. And that's before the expense is committed. And that's a very important concept in your delegation of authority policy, is that this really ensures that at the point of decision making, the right people are involved in a spend decision before it's actually committed. So once the invoice comes and the signature happens there, that's a bit late. It really has to be considered at the point of committing the organisation to that legal spend. So that's a very key policy to have in place. Another really important financial policy is called a segregation of duties policy. This is a really important internal financial control. And what segregation of duties is about is ensuring that the same person doesn't complete key financial processes along the way. And I'll give you an example. So the person who is entering an invoice, for example, into the financial system should not be the same person who is releasing the payment in the bank. They should be 2 separate people. This makes sure that you've got the right checks and balances along the way. And this is a very important policy to prevent fraud. So it ensures that along a financial process, some of the key steps are completed by different people. Another example may be the person who enters the bank account information for a vendor in your financial system is again a different person to the person who enters the invoice. And that ensures, again, that there's that separation there and a double check. Checks and balances are taking place by different people. Another important policy is your cash management policy. This is particularly relevant if your organisation is handling cash and may be dealing with large sums of cash. If there's donations, for example, really depends on the nature of your not-for-profit. This may include things like how often cash can be held on premises, how soon they must be taken to the bank, the process for banking, making sure that there's segregation of duties there as well. So those are the types of things that would go into a cash management policy, particularly. Again, this one's really, really important because it is always considered one of the highest risks when it comes to fraud is when an organisation handles any cash, actually, even if it's petty cash. That's considered a quite high risk area from an audit perspective. Another one that you would want to consider very soon after incorporating is an expense reimbursement policy. It's very often the case that unless an organisation has a credit card, for example, that your employees may be using their personal cards and then seeking reimbursement. So having a policy in place about what is deemed an allowable expense to be reimbursed, and the timeframes for reimbursing an employee, some rules around things like travel, that would all go into your expense reimbursement policy. Some organisations have an expense reimbursement policy for directors as opposed to employees, and some have them, the one policy kind of covers the two groups. Another really important policy is the budgeting and financial reporting policy. So this outlines key dates for when a budget process should really start to be commenced, and that's usually minimum kind of 3 months before the end of a fiscal year if you want to really go through the process in a meaningful, robust way. It will also outline the financial reporting expectations and obligations of your finance team and your CEO as well. So it may say things like there is the expectation that the financial reports will be completed by the 10th or the 15th of every month. And so this ensures, again, that there's accountability and that even if people may change, those key rhythms continue throughout changes that may take place. So now we're going to talk about financial statements. This is going to be it's going to be very high level. I'm just going to go through some of the basics here. And if you seek some further information, we do have an info sheet that supports this presentation, which will have the opportunity or provide opportunities for you to really dive deeper if you want to do some all things financial, which I always think is super fun. So when reading financial statements, there are some key things you have to think about. So one of them is to make sure that when you're looking at your financial statements, or you can answer the question as to whether what you're looking at is accrual basis or cash basis. So what does that mean? So if financial information is presented on a cash basis, it means that and we'll go through a statement in just a moment, but essentially it means revenue that you see on a report is only reflected when it's received in the bank, for example. So if it hasn't yet been reflected in the bank account, you won't see it on the statement. Accrual basis is not so intricately linked to the bank statement itself. So if it's not in the bank statement, that's the only trigger point for recognising either an expense or revenue. So that's the cash basis, completely driven by the bank. Whereas accrual basis is quite different. So it's not just about what's gone in and out of the bank. The accrual basis requires organisations to consider commitments. So if, for example, you have an organisation puts in an order for that stationery example that we just spoke about earlier, and there's a purchase order, for that stationery, you would say that that commitment has been made. And if there's a delay on the invoice, that may come a little bit later. You would still reflect that in your financial statements. Likewise, if you have an invoice that's come through for that stationery, but it has terms of, say, 30 days, you don't have to pay that $1,000 for 30 days. You've got a very good supplier there. You would still reflect that $1,000 in your financial statements. And what you would also show is that there's an accounts payable obligation to that vendor on your statement of financial position. Okay, so in a very broad term, the cash basis really is reliant on just simply what's gone in and out of the bank account, whereas the accrual basis also does that, plus considers all of the commitments of the organisation. Commitments both ways. So there's commitments for money that's owed to the organisation, as well as commitments that have been made to others. Now let's talk about the income statement and the balance sheet. Okay, so the income statement, so this one is going to be, let's assume that this is the accruals basis. So most organisations will elect to use the accrual basis because it gives a more accurate picture of the financial position and health of an organisation. So an income statement has two sections. The top part of the financial statement will reflect or report all of the money that has either come in via your bank account or is due to an organisation. And so in this particular example, you'll see that, and this is very common for a not-for-profit organisation, there'll be grant income. So this is usually, from your funder. It'll have a grant agreement, which we spoke about a little earlier. There might be some donations, and there may be some interest that has been earned on the bank accounts. This would be very common in a not-for-profit environment to see, these three key areas: grant income, donations, and interest income. Again, there may be many, many others. So this is a very, very simple kind of example here. And you'll see here as well that it is very common in financial statements to see a comparison between last year and this year. So in this example, you'll see that grant income for last year is shown as $50,000 compared to this year of $200,000. Donations last year $6,000, this year $5,000, and a small amount of interest. So in this particular example, the total revenue is the line item that shows $200,000, $206,000, my apologies, for this year. Now let's consider expenditure. So some examples of expenditure are things like your salaries and wages, some professional fees, things like your electricity, your utility expenses, and that all-important insurance expense. It's really important to highlight also some of the differences in the expenses when it comes to your programs. So in a not-for-profit environment, expenses are generally seen in some kind of two key buckets. Those expenses that are related to programs specifically, and those that are considered overhead, okay? So overhead may include things like management, your finance team, rent, for example, and program expenses may be associated with like the direct fulfillment of that activity. For example, if at a community association you're providing dance classes, it might be the cost of supplies, for example, to provide that class. Okay. You'll then see that the total expenditure is at the bottom of that statement. And really what this report is telling us is what is the deficit or the surplus when you consider all of the revenue and you take away all of your expenses. Okay. So in this particular example, you see there that there's a surplus. There's additional revenue compared to expenditure. Now, in this particular example, a funder may have some concerns about that. So if a funder is expecting that $200,000, for example, is fully spent in a year, they may have some questions as to whether the obligations under the funding agreement were fully adhered to. So it really depends on the nature of the revenue in your profit and loss. It's going to start to reveal potentially some further questions and or potential issues. Okay. Another important consideration when thinking of your income statement as opposed to your balance sheet, sometimes I like to use the analogy of the income statement is how you ran the race. It's always about what took place in a certain time period, whether it's 12 months, whether it's a month. Whereas your balance sheet is your fitness kind of at the beginning of the race at any time period. So what is your financial health? How healthy was the runner before they started the race? That's really how I like to think of these two statements. Okay, so we spoke about the income statement, which was how you ran the race, what took place in the year, and if there was excess revenue after all expenses have been paid or not. Did it break even? Was there a deficit? Your balance sheet considers the health of the organisation. So you will often see in a balance sheet, or you will always see, I would say, in a balance sheet, two key areas. One area is the assets of an organisation, and one area is the liabilities of an organisation. So a liability are things that the organisation owes to other people. A very important part to think about. So you always have to review both statements together. If you review one without the other, it really doesn't give you a complete picture or story of the financial health of an organisation. So in this particular example here, assets are divided between what's called current assets and non-current assets. So non-current assets are those assets that are considered to have what's called a useful or a life beyond 12 months. It's the accounting kind of definition there. So what commonly is seen under non-current assets are things like fixed assets, some property or a car. Those types of things would be reflected under non-current assets. What you would see in current assets, things that you will likely use in the next 12 months, are things that are liquid, so cash, for example. So cash, accounts receivable. Accounts receivable is monies that are owed to the organisation. Inventory, if you have inventory on hand, if you may be maybe selling shirts, for example, you may have a few boxes of those shirts that you have for your next event. You would put those into your inventory, depending on the value of the shirts. And you'll see there that this balance sheet then highlights the total value, so total assets there of 143,000. So what are some types of things that you would see in liabilities? Well, again, like assets, they're always split between current assets and non-current assets. Liabilities, likewise, are split between current liabilities and non-current liabilities. So in current liabilities, you'll see things like, particularly if you're using the accruals basis. So again, this is assuming the accrual basis, not the cash basis. Things like accounts payable. So with that example of that $1,000 for stationery, if that vendor has given you, or the supplier has given you 30 days to pay, that $1,000 would be reflected right here against accounts payable. So you'd see it as an expense on your income statement, and you would also see it as an obligation here, that $1,000, that it hasn't come out of the bank yet. It's due to be paid at a point down the track. But you still want to capture it because the stationery is in the office. So there's been an exchange of goods. Deferred revenue. What is this? Okay, so deferred revenue links back to the example that I was speaking about moments earlier with respect to grant income. So if grant income is unspent at the end of a fiscal year, then using what's called the deferral method, a not-for-profit will reflect that it's unspent in the balance sheet. What does that mean? Well, it essentially means that anything that's unspent from a grant, it's not really a not-for-profits to keep and do what they like with. Rather, that money is to be spent at a future date in line with the grant agreement, which is why at the end of a fiscal period, anything that's unspent for a grant is reflected as a future liability. So then in a future period, that income is then reflected as revenue, and then those expenses continue to take place. Okay? But without doing that really important accounting entry, it doesn't give the right picture of the financial health of an organization. Because in theory, anything that's in deferred revenue, you should really see that number up in your cash and cash equivalents. Okay? Because for grant income, that has to be spent in line with for a specific purpose. And so at the very, very, very least, that $15,000 there as that example should absolutely be showing as in the cash and cash equivalents. And as you can see here in this example, it's well above $15,000, which is what you would expect to see in a healthy organization. So other items that you may see in current liabilities are things like accrued expenses and payroll liabilities. That's a very important one. And one that you in a not-for-profit organization, you really have to pay close attention to that particular liability and making sure that there's full compliance with all CRA obligations. Okay. So when looking at a balance sheet, I always encourage organizations and boards to look at the difference between the assets and the liabilities, in particular, the current assets compared to the current liabilities. So in this particular example, the current assets are $123,000 for this year in the example that we're showing, and the total current liabilities are $23,500. So you always want the ratio, it's called a solvency ratio, to be what's called above 1. Okay, so in this particular case, total current assets divided by total current liabilities is absolutely above 1. And so in this particular example, this organization is said to be what's called solvent, financially healthy. So if that ratio was below 1, it may be starting the slippery slope towards insolvency. So when looking at a statement of financial position or a balance sheet, there are some really important metrics that you can just really quickly check to gauge the financial health of any organization. So why does all of this matter? And it really, really, really does. So if your society, if your organization has incorporated, in order to protect that incorporated status and ensure obligations with bylaws, and to protect directors and officers and ensure that they're able to discharge their duty of care and their duty of loyalty. Having all of these critical frameworks in place, having the policies, having the review of the financial statements, ensuring that there's consideration of things like the 5 stages of financial wellness, making sure that all those areas, particularly in stage 2, financial fragility, are addressed in place to ensure that strong structure is there. It prevents things like fraud. It's not going to completely do away with the risk, but it does absolutely mitigate the risk of fraud within your organizations. Having all of this in place and making sure that this is all implemented as soon as you're incorporated, before you're incorporated, I would say, if you're dealing with money in any way, is the ability to make informed decisions. So with the provision of financial information, your organizations, your board, your employees won't be making decisions in the dark. So that is another reason why ensuring that all these key things are established as soon as possible. You'll be able to demonstrate to others in the community and funders that there's sound governance. And this is going to greatly help your organizations when it comes to being successful with other funding applications. Mission, vision, and values. When key policies and frameworks and financial controls are not in place, it diverts precious time on those activities and distracts organizations from focusing on the activities that really are what it's all about, which is about focusing on mission and vision and your values. And lastly, by focusing on all of these key areas, you really create the opportunity for strategic growth, which again is always linked to vision, mission, and values. So with that, thank you so much for the opportunity to present to you today. As mentioned previously, we have an information sheet that will provide a lot of detail if you want to dive into any of these areas. And I wish you all a fabulous remainder of your day. Thank you very much.